morning, good evening, good wherever you are. I've been honoured and pleasured to be joined by Angelo Amara again. Hopefully this will be part two of the first episode, which was absolutely unreal, and I strongly recommend you get onto it. And today, fresh from Sydney, Rockin' Ronnie, the heavy hitter out of JLL. It's a tight schedule, but we've locked him in. Rockin' Ronnie.
Nice to be here.
Welcome.
Thank you. Thanks, Pass. Appreciate it.
We were chatting earlier, and I think I'm going to start with probably the brief history of Rockin' Ronnie. You were at REWA for 4 years. For those that don't know, I guess it's probably like the biggest institute here in WA, the main institute. You broke into JLL in 2021.
I moved into JLL in 2018.
2018,
so,
yeah. Directorship in 2021.
Correct, yep.
In your early 30s.
Mm-hmm.
JLL, as Angelo also works, is listed on the New York Stock Exchange, and Rockin' Ronnie has the fantastic seat of the National Real Estate Economist.
Yeah, no, look, I've been in that seat for the last 15 odd months, been a director since 2021. Came in as an associate or a manager back in 2018. So, I've been through a couple of roles within the company, and it's great. It's going well. I think my role as an economist, a real estate economist, is I find it to be quite unique because, every day is different as far as the economy is concerned. Even the property markets are highly dynamic compared to what they used to be historically. And, when you start to look at what's impacting property, interest rates, inflation, it's all very topical, So I'm quite happy to be there.
Absolutely. Yeah. And on a day-to-day, both yourself and Angelo work close together. What's the day in the life of the two boys look like?
I'll start with banter, I think, mate.
A lot of banter.
Yeah,
look, I mean, I must say, and because Ron wouldn't say it himself, but first of all, it's pretty cool for us as a WA office to have a national role like Ron's parked here. It's pretty rare and a testament to Ron's abilities that the business has been happy to kind of park, a national economist role in WA. So I guess in terms of our day-to-day, I mean, Ron sort of touches most of what we do across the various disciplines of sales, leasing, management, and so forth, and often is helping us shape either discussions with clients, bids and pitches that we're running, and I think really just augmenting what we do day to day. And again, as I said, probably in between all that is a hell of a lot of banter. But no, it's fantastic. I think the rapport that we've got with you and your research team.
Mm-hmm. Yeah. No, absolutely. I think it's as Ange said, it's a bit like being in a trading floor sometimes when you're working with agency and Angelo, when you've got the office leasing guys and you've got capital markets, and it's the conversations can go from varying degrees depending on the day. And we talk about sports and what happened overnight in football, and the next thing we're talking about news events and so forth. But at the end of it, we're also very serious, and we are serious about what we do, our craft. And when it comes down to business, we're heavily sort of engaged individuals, all of us.
Well, one could probably say it's a Batman Robin type of
he's definitely
Robin.
He's telling me I'm Robin.
Yeah, well, like
you can be Aquaman, I reckon.
Aquaman.
I might take that as a compliment.
Absolutely. But obviously, the point I'm saying is that there's a lot of insight that Angelo would require to get deals done, and vice versa, what you're seeing and probably what you're seeing. Is that a fair comment?
Well, it's pretty symbiotic. I mean, I guess a lot of, so to your point, absolutely. We need the insights and the broader macro story all the time. But obviously, Ron on his side relies upon a lot of that data stream in terms of deal flow to then form a lot of the insights that then spit back in various ways. So, I mean, it's a two-way street, I guess you'd call it. Yeah.
Good. So let's talk all things property, because that's why we are here today.
Yep.
Rockin' Ronnie, you've just flown in from Sydney to be on the podcast, which is huge.
No one's going to take me seriously. You know that, right?
No one does anyway.
So tell us about AI and property, because I think I'm gonna touch on this, particularly fresh off from Sydney. Obviously, recently did a presentation. So
I did.
Tell us some of the things that we should be aware of, or some of the trends, and I guess, and then we can get into probably some of the WA based questions.
Sure. So look, AI has obviously been talked about every day.
Yeah,
and you can't go through a news headline, open Bloomberg, CNBC, whatever news channel you want to open, everyone's talking about AI. But the impacts on the property market are a little bit hazy at the moment because AI is still revolutionizing the way we live and the way we work, and everyone knows about ChatGPT and so forth. But within JLL, we have a suite of tools, AI tools that we have invested in over the last few years, and we capture that in terms of our AI universe. But more broadly, when you're looking at the property market, there's a couple of things I did over the last couple of months, along with my colleague Bianca Docker, who's based in Sydney in the office leasing team, and we essentially try to educate ourselves about AI. And that was essentially the theme was, how can we essentially expand our knowledge base here, defining AI, what is AI, why is AI important, what sort of jobs will AI create in the future? There's a lot of negativity or negative connotations around AI replacing jobs in the future. And whilst that might be true in some cases, I think the broad view is that it's not going to remove jobs. It's going to essentially create new roles, and existing roles will need to be shaped and we'll need to upskill or retrain in order to be able to use some of the AI tools at our disposal to make us more efficient and boost productivity as a result and boost output. So that's the theme that we went down under. And then we identified who are the major or leading cities or countries around the world, and what are they doing in the AI space? So obviously, if you look at San Francisco, they're a clear leader in that space. You look at how much VC investment's happening, or venture capital investment into markets like San Francisco and Silicon Valley. The growth story there has been ridiculous. Now, if you're looking at the office market, in terms of how much space is being leased in those markets, we've seen AI grow every year over the last 10 years in terms of its take-up of office space. So we're talking about small AI companies. You think about autonomous vehicles. There's a lot of companies. It's not just one or two companies. There's hundreds of companies in that space. And they all have a little bit of a footprint in the US because they're all trying to sort of cover new ground. And then you've got Gen AI, which is generative AI text. For example, ChatGPT. We actually have our own version at JLL called JLL GPT, which we'll use in-house. And I actually have that as one of my first browsers because I use that quite extensively. And Angelo, I'm sure you use that as well.
Mate, it's actually, I think we were discussing it the other day, mate, it's becoming almost a bit scary how often we're using that now. It's become sort of second nature, like any other tool that you use, whether it be your web browser or Outlook or whatever it might be. It's just, I think, very much entrenching itself into what we do day to day and kind of taking a lot of those mundane tasks right out of the equation.
Yeah. So then coming back to Australia, when you look at Australia relative to other global countries or cities in this case, you're comparing Australia as a country relative to San Francisco, New York, Silicon Valley, London, Tokyo, etc., where there's a lot of AI investment happening. We find that we're still at the infancy stage. We're a very nascent sector when it comes to AI. AI is not really a sector, but let's just call it that for a second. But when you're looking at knowledge workers, for example, people like us using JLL GPT or ChatGPT and other AI tools, we're right up there. We're actually probably second. We're second on that list as far as the ranking of knowledge workers is concerned globally. Singapore leads the way. Australia's up there in second. So we clearly use the tools that are at our disposal. But we're still a relatively small sector when it comes to AI and investment into AI. So it's essentially uncovering some of those trends. What will make or break us moving forward from an AI landscape? Will we see large companies take up more office space in Australia because we've got a higher proportion of knowledge workers here relative to other parts of the world? So that was the angle that we went down. And to keep it short, the conclusion of that is that whilst we might not achieve some of those growth rates that we've seen in San Francisco in terms of office space take-up in those markets, we're obviously comparing ourselves to very extreme markets. This started 60 years ago. The San Francisco story is interesting because the first electronic shop opened there in 1940s, and Silicon Valley obviously got its name from manufacturing chips, and that's where that name came from. So there's a long legacy, a long history of that. We don't have that. Whilst we don't have that, we can still expect a lot of growth from some of these major players, the major tech companies, the likes of the Googles and, the companies that are heavily investing in that space, but also small AI companies. So there's about 414 companies, AI companies in Australia that are registered.
Right.
And we're a top 10 player when it comes to ranking those AI companies worldwide. We don't have 10,000 companies like we have in the US, but we're still in the top 10.
So am I correct in understanding that you believe there's going to be an uptake of AI-based companies in commercial real estate? Is that a fair assumption? Or?
So essentially the conclusion of that is that we expect growth in the AI space moving forward. And what that will mean is we'll see new knowledge workers creep into that space. So software developers, script writers, people that actually work in the Gen AI space, all of those people will need office space moving forward. And, you can look at AI from the perspective of Gen AI, robotics, life sciences. If you look at all those three sectors in the US, a large chunk of the requirements within those three sectors are in the office market. They need office space. They need warehouse space. They need other sort of space as well, but they really need office space as well. Our market is still at a very nascent stage. So as we see that growth expand and requirements grow, we'll see more take up within the office
Ron,
market.
It's a good point, obviously, that we think that the share of the pie in terms of space occupied will obviously dramatically increase as AI takes precedence. But in terms of just thinking, drilling it down into the use cases within commercial real estate, a good one that you and I, are well across internally is looking at how we might predict, for example, an asset that an institutional holder might be looking to divest based on a multitude of various parameters.
Horizon, absolutely.
Like fund redemptions and everything that kind of creep into that. What's the estimated hold time and so forth. So there's a lot of empowering aspects of where we're even seeing it roll out as we speak.
It's powerful. So that example, if you shed that further and you explore that, we could ring an owner and say, hey, Mr. X or Mrs. X, you've got a typical hold time of 6 years. We see that the asset that you hold is approaching that hold time. You've got debt expiring in 6 months' time or in 12 months' time. What are you considering at the moment? So we're almost trying to be ahead of the game as opposed to waiting for that phone call to come from that owner saying, let's discuss my options. We're literally anticipating that move using AI, using some of the tools that we actually have at our disposal. Horizon's one of those.
Okay. Yep. And I would suspect then it's not necessarily just the client's property being the whole time. There's a whole series of different factors that are then considered, which again we can probably dive into that. So let's talk about the movement in WA, office occupancy space. Where are we sitting at the moment?
No, you want to take it off.
So I guess in terms of the headline vacancy rate in WA now, it's just north of 15%. Down from a peak of 25 plus some years ago. And that's obviously trended down consistently during the COVID years and now post-COVID. So, trending well, I suppose you'd say, as a sort of a high-level comment, notwithstanding the fact that we came off a pretty average, base pre-COVID. But if you look at the trend line for WA versus some of our peers on the East Coast, probably Brisbane excluded, we've had probably, you'd say we're second in the country, right, Ron, in terms of how we're trending. Right. Second behind Brisbane.
Yeah, wow. Yeah. Right. And how does that impact economic productivity?
So
is there a direct correlation?
I think it's more about economic productivity impacts the office market.
Correct.
Okay,
right? So it's the other way around, because as you see more output in the economy, if you see the labour market growing and you see population coming in, there's a lag, obviously, but the resulting conclusion is that you need more office space in some shape or form. So I think that's why Angelo correctly identified Queensland and WA being a little bit of an outlier examples over the last 3 years, especially since 2021, the first year after the start of the COVID-19 pandemic. The reason those two markets have done fairly well and have outperformed the national average is because of the resources sector. And if you go back to the resources sector, if you look at labour market growth over the two states, it's been the strongest in the country over that period. So we've seen population coming into WA leading the way as far as population growth is concerned, and Queensland in second. And that's been a consistent theme over the last 4 years. And what that's meant is when you're looking at the office market, obviously we've seen an expansion of the office market in terms of the tenant base, largely dominated by Queensland and WA. So it kind of makes sense when you're looking at it it starts from a macro perspective, which is, I think before we started the podcast, we like to talk about property more from an economic perspective and then drilling down to property as opposed to the other way around, which could work as well, but generally it's nice to sort of form that macro view first. Yep.
So in the event of resources prices, I guess, probably correcting in the last 6 months.
Which is what we're doing. We're in that phase now.
How does, again, what is the lagging month time period between a resource price movement,
Yep.
and a commercial real estate trend.
Mate, we have shown charts that for Perth look at the overall vacancy rate, which Angelo's mentioned, just north of 15%, 15.7%, along with the iron ore spot price. And it's you can't say that there's a correlation there. So just by looking at the iron ore spot price doesn't really tell you what the market's doing at a granular level. What we really like to look at is what we're exporting. So if you're looking at WA's economy in terms of what we produce, half our economy is exports, and half of our exports go to China. So the way I like to really dumb it down is by saying that China is responsible for 25 cents on the dollar in terms of what we produce here in WA. It's a massive portion of the pie, Chinese demand from China. So rather than looking at the iron ore spot price, I essentially look at exports, the volume of exports that we're producing. You look at the fundamentals of the large mining companies, whether it's BHP, Rio, FMG, and then you've really got to assess, all right, if you put a blend view around the average cost of production across the big miners, you're looking at roughly $20, $20 per ton. So you look at where iron ore prices are right now, roughly about between $100 and $110. It's more than sustainable for them to continue making profit, for them to continue mining their product and exporting it out. When iron ore prices, when iron ore prices get down to about $30, $40, then we're talking a different story. Then you start to see sublease space potentially come to the market.
I was just going to say that probably the closest you'll get to a correlation is that sublease vacancy rate rather than the headline vacancy rate, meaning, where you can exit space quickly or where you'll see that uptick quickly is in sublease, whereas you've got to keep in mind, typically in a commercial lease context, you're looking at anywhere from typically a 3 to 5 year lease term and sometimes longer. So there's a massive lag effect in that headline number. So it's probably, as I say, the closest you'll get is looking at sublease.
Yeah, and being in West Perth, that's one thing that we noticed back in 2016 when we started the firm.
Yeah.
It was almost there was tumbleweeds down Hay Street.
Yeah.
It got to that level from seeing Bentleys and Lamborghinis driving around to
Yep.
seeing no cars on the street.
Yeah.
Paz only sees his own one now. That
I just see Rock and Ronnie's private jet, mate. That's all I see.
Not
flying
quite
around
there
the
yet,
country.
mate. I don't think I can afford the wheel yet, so let alone a plane.
West Perth's a really interesting one in that there was a period, in peak mining boom years where West Perth was the tightest market in the country.
Yeah, wow.
I think it was sub 1% vacancy. Wow. Insane.
Yeah.
So it's definitely, it blew out like the Perth CBD did. It's definitely contracted again, but we're starting to see a little bit of that uptick.
Yeah,
again now.
I think West Perth's interesting because you've got junior miners that come here. You've got, small lawyers and so forth. A lot of those companies eventually want to centralize into the CBD and, closer to amenity, transport, larger floor plate sizes, newer buildings, closer to connections as well, other businesses that you might want to work with. So typically we've seen historically there's a centralization story from West Perth to the CBD, still evident in the market. And as companies grow, the junior miners become larger. They go from micro cap companies to small cap to medium cap companies. Their requirements grow. Their labor force expands, and they need to look for space in other markets. And CBD is obviously a market where they look at because it's larger and they want to compete against some of the other players. So that's why we've seen that market evolve from you grow in West Perth, seed-based companies, very startup companies, they then expand into the CBD. What we've seen over the last probably 3 years, up until probably the start of 2024, West Perth formed its own niche, where that vacancy rate, which is really high, started to taper back down very, very aggressively. So, at some stage, I can't remember the numbers exactly, and I probably should, but it was a very aggressive drop in the overall vacancy rate when it comes to West Perth between 2020 and 2022/early 2023. And that was, a lot of that was driven by what was happening around commodity prices, new miners coming into the space. Lithium prices were really elevated 18 months ago, copper prices, aluminum prices, and so forth.
I think nickel was in there as well.
Yeah, nickel was there as well. Yeah. So you look at the expansion phase of some of the major players. Companies like Pilbara Minerals went from you look at their stock price and how it exploded over the last 3 years, up until probably about 6 months ago. So their expansion resulted in the need of more space. Liontown's another example as well. And they took up space in West Perth very, very aggressively. So the market's rebounded. And it probably more aligns with the CBD market now. So if you look at West Perth and CBD, I feel like they're more comparative now.
Yeah, right.
Okay. So I agree with that.
Yeah, okay. So on that point, let's talk both east and west now. So, Angelo, in our chat, we're talking about the spread of the risk basis points and how that's moved.
Yeah.
Why invest in WA? Why not in the east? Why is there I guess, this demand or lack of supply maybe as well in WA?
Mm-hmm.
Obviously, at a resi point, we can probably understand it, but what's happening in the commercial space?
Sure. So look, we got to be careful because when you're talking about YWA over New South Wales, every investor is different, and what their appetite to risk is also very different. So historically, if you want a little bit more risk for a higher return, you'd look at WA because you've had a higher spread to the risk to the Sydney yields, for example. Mm-hmm. If you wanted, a low risk market, core market, proven track record, major capital city, Sydney and Melbourne are clearly those markets, and it kind of makes sense. So it comes down to investor appetite and what they're actually after. And there's still investors who would say, look, we just can't invest in WA. That's not our mandate. We only want to invest in Sydney and Melbourne, where the largest population hub is, and we see those cities as cities with a proven track record. We get it. But what we've seen over late is that the spread between Perth and Sydney has somewhat narrowed relative to its historical average. And essentially what that means is that initially, or historically, where Perth was probably perceived more as a riskier market, whilst that's still the case, it's probably not at the same level or the same intensity as it was before. And I think a lot of that is down to the fact that if you look at the last 3 years, we've consistently proven that we've got probably one of the strongest economic growth rates in WA compared to other parts of the country. And in this case, we can say New South Wales and Victoria. Highest population growth, higher wages growth, which has been historically the trend because of resources. Mm-hmm. We can go on. We can keep talking about variables and see that WA has shown a consistent outperformance story. So by that metric, you would then say that you need to adjust your risk expectations. WA is no longer as risky in inverted commas as it probably was perceived historically, and now it's more of a market that's probably more in line with a Queensland sort of market, probably just behind in terms of the risk appetite towards investors, because Queensland's still a little bit more diverse than we are.
Sure.
There was a chart that I showed last week. Our executive team from around the country were over to celebrate our 60th anniversary, and I essentially showed all the 5 major states. And you look at what makes up 50% of each of the state economies. WA, 45% mining, 5% healthcare. 2 sectors make up half the economy. New South Wales, ownership of dwellings is the largest contributor to their economy. It's about 5 or 6% of their economy. But there's another 5 sectors on top of that make up half the economy. So there's 6. Victoria's got 6. South Australia's got 5 or 6. Queensland, 13% mining. But there's another 5 there that make up half the economy. So when you're looking at the diversity of state economies, they're a lot more diverse than we are.
It's a good point as well, right? Because whilst I think we often get spoken of as being quite similar to Brisbane, there's still a massive spread in terms of that mining sector.
There is,
reliance, right?
Yeah. But the good thing is that the mining sector has been a sector of strength since 2020, and I keep sort of referencing this number. COVID obviously created a lot of disruption, health-wise and economic-wise. But I think WA actually came out looking pretty good from all of it. Not just from a health perspective. Worldwide, we were considered as being a state that probably didn't have too many issues from a health perspective. People may have stopped moving around, but commodities were still moving around. So our economy was still functioning fairly strongly. And there was a knee-jerk reaction from world governments to invest in infrastructure projects because the labor markets were shot across the world. I think we lost about 8 or 9% of our labor force very quickly, nationally. And this is a trend that we observed globally. Some markets had worse sort of implications of the labor market. So governments there scratching their heads thinking, how are we going to spur economic growth, right? And they decided that they're going to invest in infrastructure projects to try and boost economic growth. Thumbs up for WA because we've got the iron ore in the ground. So exports shot up. Value and volume, so we benefited significantly. And now we're sort of still seeing the after effects of that because that infrastructure deployment takes time to complete, which is why we've seen this current mini sort of economic boom here in WA within the resources sector. A lot of that has been driven by the fact that the 2020 reaction in terms of infrastructure projects needed to be deployed across world governments is probably now reaching its sort of saturation period, its peak period. And so we've been quite lucky to see that in some way.
One of the things I also think is worth reflecting on, and Ron, this is one that I think you coined a few years ago in some of our presentations with clients. there was always this narrative around, when is WA going to diversify outside of mining? When's it going to happen? How's it going to happen? But as you see that share of our gross state product only increase in terms of the mining component of that, I think we've really tried to push that discussion more around diversification within mining rather than outside of, because we're just never going to get away from that, right?
It's when I started at JLL in 2018, I used to show the same chart, the economic contribution of mining relative to the state economy. It was in the late 30s.
Right.
And at that point, people are scratching their heads. Wow, 37% of the
How do
economy is
we
mining.
reduce that?
Now it's 45%.
Yeah.
So at some stage, you've got to be like,
We are what we are.
we are what we are. And if you're thinking about some of the other global countries, like UAE is a good example with oil in Dubai back in the day, they've really transformed their economy into something beyond oil, right? They've gone into tourism, right? So for us, it's a matter of capturing the income that we get from resources, building a strong foundation. 50% of our economy is resources, yes, but how do we use those funds to essentially make WA more than just resources? So using resources sector to diversify our economy, using that income.
But even on more than just digging it out of the ground, so it can still be within resources.
Oh, yeah, renewable
capture
energy.
more of that, right? And
Lithium's another talked about story for the future. And lithium's an interesting one because if you look at global lithium production, half of global lithium production in 2022, we're looking at numbers slightly outdated, was from Australia. But 95% of the Australian production was from WA. So really, we're responsible for about 46 or 47% of global lithium production. And if you believe in the story of electrification and EVs, and eventually we will have to move towards that, we're in a really good situation again. So again, we're fairly lucky because of the endowment of natural resources at our disposal. But how do we make the most out of that?
Yeah, and this is probably the position that I've taken on it is, as a government in the state, we just tax it. Right? Just put a royalty on it. Thank you very much. I believe that there's far more value in some form of co-investment or JV where the government would step in, similar to Dubai and China. SOEs is what I'm referring to. They come in, they can work with these parties, provide an alternate to the mining. So yes, we understand BHP, you're doing X, but why don't we use this to develop Y? As a government, we'll step in. We'll provide some form of initiative or backing or funding or tax incentive or whatever it is. And therefore, when we talk about diversification, it starts with the government. And that way, then you'll start to get more businesses buying into it. I don't know what your view on something like that would be.
It's a very good point because if you look at what governments generally do, they try and tackle that situation by themselves. And they try and boost tourism. They try and boost the education sector. They try and boost healthcare using their own initiatives. But if they start partnering with some of, let's say, the major resources companies to get them to achieve those diversification goals, it could be quite powerful.
Absolutely. And when we talk net zero by 2030 and net zero by 2050.
Increasingly 2050, I think.
2050. Exactly right. It just keeps getting kicked down the road. The only people really that have the power to do that is probably the government. They can start greenwashing, but that's not going to work because that's fundamentally not actually what we're achieving as a country. And as the global, it was the Paris Agreement, I think it was. This is where it obviously commenced with, right?
I think it was the 2018 Paris Agreement.
So there has to be some form of, I'm going to go to it. So green bonds. I don't know if you're familiar with green bonds. In Australia, they've recently deployed it. Again, it's part of developing in green projects. That is something that in WA we really need to be tackling, and that could be the driving force about this diversification from mining.
I agree.
But definitely.
There's such a steep learning curve that we need to go through. We've only just set net zero goals in the last few years, 2050 goals, or world government's still trying to figure out how we get there. And, by and large, I think it's a fair assessment to say that we're behind. All governments around the world are behind their net zero targets. So something needs to change or shake up in that market to essentially get us to achieve those goals that we need to.
I'm just thinking, pivoting back to the real estate story around the net zero carbon piece. We've also got an interesting dynamic in WA where we've got a very large share of our occupier base being resources sector centric that are very much driven around net zero carbon targets and greening their operations. Yet we've got one of the oldest stock pools in terms of office in the country. I think we're only Adelaide's older than our stock pool. And so we've got this kind of interesting paradox between a whole bunch of occupiers that are screaming for greener operations, office being a component of that, they're really old stock pool.
I mean, there was a nice photo in the West Australian with Angelo with his hair sort of creamed back with wax, talking about this same topic a few months ago. And I was
what was your hair doing that day, mate? I think it was probably about that high.
Having a bad hair day on that day. But essentially what we were talking about in there was we mapped out all the occupiers in Perth, all the office occupiers, what sectors they're related to. And if you look at the mining sector, 75%, I think it was, of mining tenants have a net zero target. Government's got a 100% net zero target because, we know what the government mandates are for net zero. You look at professional services, they're in the 70s as well. Real estate's probably in the 50s or 60s. But when you draw a straight line through all the numbers and you look at the 1.4 million square meters of occupied space in the CBD, roughly speaking, 65 to 70% of tenants in Perth have a net zero target associated to their business name. But if you're looking at how much supply is out there, forget about net zero stock. We're just talking about neighbors ratings going from 1 star all the way to 5, 6 star neighbors rating. We have very few buildings that can be classified as net zero. Probably a couple of buildings, off your fingertips. And if you're looking at ranking Perth relative to other parts of the country, the average neighbors energy building in Perth has a 4-star associated or attached to it. Adelaide's got more, older stock relative to Perth, but even they've got a higher neighbours energy rating. Sydney and Melbourne lead the way, close to 5-star in terms of the average building there. So we've got a lot to catch up on as far as delivering new product that can be classified as being close to being to net zero.
And Ron, particularly when I don't know about the Sydney number, but I know if we take some of the US markets that are heavily fin-sector driven, what you've mentioned in excess of 70% occupiers with net zero carbon targets here, but it's probably more like 35.
It's 40, 50% if you look at a market like New York.
There's greater demand, arguably over here for that product, yet we've not got anywhere near.
And that's skewed by the resources sector. So if you had to rank Perth relative to other global cities, I reckon the requirements from tenants in terms of their net zero targets would be up there, would be up in the top 5 places. Rio Tinto, BHP, Chevron, FM, they all have net zero targets and they occupy large chunks of space in our CBD.
But fundamentally, the cost associated with going net zero is unsustainable, in my opinion. People actually have not sat back and quantified the cost it will take for a normal SME and or a large business like BHP to achieve this net zero target beyond the fact of greenwashing. And this is my position on it. We can all be net zero. I'll just go buy a bunch of carbon credits, offset my carbon footprint, look at me go.
Yep.
What fundamental changes are you going to make in your business? What is the cost of making those changes? And tell me over the next 20 to 30 years whether or not there's going to be repayment on that as compared to other capital deployed in other areas.
Yep. Yeah,
no one has told me that.
It's a real thing.
Yeah, no one is like we can all talk net zero, and I hear it all the time.
Yeah.
What are the costings? Is it financially stable? And are we going to get a return on that capital? If you gave me $20 million and I went and deployed it in something else, tell me what the repayment period on that would be as compared to these green targets. So I think it's great. I think it's a good initiative. I know America has always provided like a reduced interest rate if it's green projects. As a state, coming back to the point, either both state and federally, they need to step in.
Yep.
They need to co-invest with businesses and or projects, and that's the only way we're going to achieve it.
Yeah, no, valid point.
Yeah,
absolutely.
So now that we've digested the commercial space, let's talk resi. So
we can talk resi.
So we were talking Rentvesting, and I'll let the experts explain what that actually means. But what is Rentvesting? How can people do it? Should they do it in WA?
You can kick it off, and I'll join you.
Yeah, sure. So I mean, what is Rentvesting? In reality, it's simply renting where you want to live, buying where you think you'll actually make a better return. So obviously, still purchasing property, but not necessarily the property in which you live. Should people do it? I mean, I've probably got a little bit more of an old school attitude and philosophy. Sort of going back to probably some of the discussion we had in our first chat, mate. But yeah, I mean, it certainly can be advantageous. But again, I guess, Ron, you've really got to be looking at the numbers and doing your sums, right?
Yeah, well, like with anything, you've got to work out what your return expectations are firstly. What's the alternative of putting that money somewhere else, and what sort of returns would you expect at what risk rate? So it might work for some people. Personally, I think I'm younger than him, by quite a large
You
margin.
wouldn't know from looking at him.
Don't do that. But I've also got an old school mentality, you know. Yeah, home ownership for me personally, I think that's it's a big thing. And even investing in property, you know, and having an income or a drip come out from there. Yeah, look, obviously this term's been coined a few years ago, and people are doing it, and it's out there. But I think for the upcoming generation, and you know the 25-year-olds to the 34-year-olds now who are in the workforce, even the 21-year-olds, they're all in the workforce. How do they get on to the home ownership ladder? It's going to be a lot difficult for them. So they're trying to find new ways of getting onto the property ladder. And I don't like using the word property ladder. It's a really weird way of putting it, but that's what they want to do. They want to get on the ladder. So they identify as this way of getting on there. Yeah.
And is it something that works, or is it relative to the advice you receive? Like, well, how would a 25 to 34-year-old sit back and go, well, this is better to rent and that's better to buy? I know how I would do it, and it's pretty simple. If I want to live in this house, I know that house is worth 1.8. I know the repayments on that mortgage is worth X.
Mm-hmm.
If I can rent it, it's worth Y. I'm going to rent it. That's my basic economic to go. For me, in my income, I don't want to be spending X more than what I should on renting and or mortgage repayments.
Yep.
That's the way I can achieve a property like that. What's your view?
There's a range of reasons why somebody would opt for, you know, let's say to buy a house as opposed to renting. Mm-hmm. And I think a big part of what they want to really answer is security. Mm-hmm. You know, renting obviously has more of a less secure aspect to it because you're paying rent. Your landlord
with a very tight vacancy rate.
Yeah.
I mean, even trying to get a rental property to
it's
start with
probably
is
hard.
Yeah.
And your landlord might decide, hey, I'm terminating the lease and so forth, and you
Yeah.
can't hit a nail on my wall, etc.
Yes.
With home ownership, you don't have to deal with those challenges. Mm-hmm. But typically, obviously, if you're comparing a like-for-like asset and you look at what your rents are, what you're paying for rent on the same house as opposed to buying it, I would rather opt for the mortgage, in my view, you know, and essentially try and pay down your own property. But that's, again, a personal choice. But I think a lot of it is driven by security.
And perhaps, I guess, from my perspective as well, whilst I wouldn't necessarily rentvest, if that is the alternative to just purely renting, would I advocate for it? Absolutely, because it still means that you're getting into the market.
Yeah.
And I think one thing it's I always reflect on a little bit as well is I think there's always a tendency for one generation to look despondently at, you know, what the previous generation was able to achieve and to have. I remember getting on the property bandwagon in 07, 08 after we'd just seen, you know, 3 and 4x growth in some markets over the kind of probably 03 to 05 span as the mining boom was really kicking off, and feeling like I'd missed out, right? And then I've kind of lived through probably close or more than a decade of fairly subdued growth in the resi sector from, you know, probably the 2010s, and then you had the COVID explosion, right? So I think the old philosophy of the Italians and others made of just, you know, buy and hold, ultimately that's the way to make money.
Yeah, probably not disagreeing. Again, it's just the difficulty that the normal person would face to break in.
I know.
Is crazy. And I know we're not in Sydney, but we've just now overtaken Melbourne obviously as a median
price.
Median house price.
I think with that though, and probably what people, because you look at it as a headline and you go, oh, that's awesome. But you've also got to look at the proportion of homes versus apartments in that equation.
Yeah.
Obviously, which is heavily skewed the other way with Melbourne. So if you unpack that, it's a little bit different. But also looking at
the gap's narrow.
The gap's narrow. But we were also historically undervalued for a long period of time as well. I mean, we're way undervalued.
Yeah, you're right. Yeah.
And I think the other consideration is how many properties are being listed. Right, the supply side, which is where really this is all stemming from. And again, I think I said in our last chat, it'd been predicted for so long. You know, this trend, at some point, it was going to happen. From the advice that I've heard and from the information that was provided to me, a lot of these big research.
I mean, I used to curate that while working for REWA.
Right.
You know, the residential vacancy rate was something that we essentially used to curate. Me and my colleague Dylan Canby, who now works for the Insurance Commission of WA, we used to essentially send out a survey to all the agents, and we used to get a residential vacancy rate, which is now advertised. Yes. Same with rental listings and sales listings. When I was at REWA, there was 15,000 listings for sale. I remember 15,000 record high listings for sale. This is 2017, 2018. And you look at the number of listings now in the market, it's a far cry from 15,000. Mm-hmm. You simply do the maths. We're getting around 50,000 people coming into the state. Mm-hmm. by 2020, the 12 months to March 2024, approximately 50,000 people came to the state, interstate and overseas.
So over the course of a year or a month?
Yes, 12 months to March 2024.
12 months, okay.
60% of that population came from overseas, and 40% of that came from interstate. Yeah, so typically WA and most states, but the large majority of population is drawn from overseas migration, and then interstate migration is the balance. So if we're getting 60,000 people coming into the state, essentially they're going to be looking for a place to rent first. No one's going to go and buy a house. Well, very few people will buy a house. Initially, they'll probably rent for 6 months to 12 months. With our residential vacancy rate of 0.9%, just new demand, we're just talking about new population coming in, let alone filling the gap from the existing population base that can't find a place to rent or buy in terms of what their requirements are. The new population that's coming in is also adding to that pressure even more. So we've got a massive challenge. Obviously, there's the housing accord to build around 1.2 million homes over the next 5 years, and that's already started 6 months. We've been through almost 6 months through that, and we're well off that requirement of what we need to build. So we've got a challenge up our hands, and I think it's going to be a very slow drip feed to try and fix that. It's not going to happen overnight. It won't happen in 6 months, 12 months. It'll take a few years to go through that backlog. And obviously the federal government's trying to sort of curb migration in as well as one of those levers, trying to soften demand. If 60,000 becomes 35,000 or 40,000, it will help. But again, you're still adding pressure unless you can build houses.
Well, the added pressure is you're withholding people from coming to the country.
Yeah.
You're trying to construct homes and or develop land, and you don't have the workforce to do it.
I know. Yeah.
So,
mate, it's so true. Past the way I see it, even if you halve migration, I like to put it this way: you're still tightening the screw, but at a slower rate.
Absolutely.
So
100%.
Yeah, and I think probably we alluded to in our last chat, Paz, it's and I'm sure probably Ron would agree with the same in terms of that forward look around what the resi market does pricing wise. It's hard to see that there's going to be any retreat, Ron. It's just that slower growth rate, really.
Yeah. It's everyone should have bought a house back in 2021, and
we all don't have private jets and buy houses, mate.
I did buy a house,
but I guess probably for the listeners, Paz, the one thing I would say is going back to my earlier point. Every generation will look back and go, my parents had it better, and their parents had it even better again. And look, there's certain things that are just unavoidable when you look at for example, the ratio between income and mortgage. That's obviously widened over time. There's no disputing there's certain aspects that are indisputable as far as you can say that to some degree that generations prior have had it better or easier, but there's always a way to get on the ladder. And I think that the key is actually just getting on.
Just get the first one. Yeah.
And I know this sounds a little bit weird to say, but that's probably why WA still got the best sort of value proposition, because affordability wise, we still have a relatively low median house price compared to other parts of the country, especially when you're looking at markets like Sydney and Melbourne, and with the higher wages. So when you're looking at those affordability metrics, we still are well placed. It's all states have gone up in terms of what your household income is required to pay your mortgage in terms of affordability, but we're still at the lower end of that scale. So I can't imagine what it would be like to be in your 20s or your 30s, whether it's a single or a dual income, to try and purchase at a $1.2 million median house price. Just the median is 1.2, let alone thinking about buying 6Ks within the CBD or 10Ks within the CBD in some of those markets. Yeah.
Oh, it's an impossibility.
Yeah,
exactly right.
It's
and
just
I think
unachievable.
You're right. You just have to bite the bullet, get in, and just make it happen.
Yep.
Yeah.
But then this is where it comes to. So you're still earning income. What do you do with that income? Because you're still saving, right? So if you're not saving for a deposit, the last thing you want to do is let that money erode in your cash account or your savings account, especially where inflation has been and still relatively is compared to long-term standards. So, by putting in a bank account, you're losing essentially, let's say, roughly 4% a year on inflation, essentially. It's just eroding the value of money. So it might not seem like a lot, but in 6 years, 7 years, 8 years, you extrapolate that, it becomes a big chunk. So you've still got to find ways of investing, whether it's not in property, somewhere else, so that when your income capacity goes up, let's say in your mid to late 30s and into your 40s, you've essentially had a bit of a return on your investment by saving that money. So it might be easier to then get onto the property ladder at some stage. Might just cushion that blow a little bit.
Yeah, or alternatively, without giving financial advice, an ETF, right?
Yeah. Look, I think it's a popular thing, and I've got a lot of friends that do it. I do it as well. It's a in my view, and I'm not trying to give any advice, it's a relatively easy way of investing and set and forget sort of thing. Passive investment, dollar cost average, market goes up, market goes down, keep investing. And, it's a classic Warren Buffett psychology and philosophy around how he built his wealth as well. And generally the rule of thumb is every 7 or 8 years, your money will double, if you apply a 10% return to it. And you don't have to really dissect any shares or any stocks or any economies, you just leave it there. So it's a popular way of investing. Some people will find it fairly useful and easy to do, and some people will still shy away from it. So, yeah.
Mate, thank you so much for coming on. It has been absolutely invaluable. Your advice has been great. You're well and truly versed in what we should be looking at, trends. Where can people find you?
Up on St. George's Terrace, usually grabbing coffee. Angelo and I are walking out, racing down St. George's Terrace.
You'll find his photo in the West Australian fairly regularly.
And you as well, mate. Look, I can drop in my details afterwards if you want to share that.
That'd be great,
You can drop into Central Park on level 31 and you'll find us there.
Fantastic.
Yeah.
Look, thank you so much for your time. It's been great. Hopefully the listeners will definitely take something away from it. I definitely have. And maybe there's a part 3 at some point.
That'd be great.
Yeah.
Awesome. Thanks, Bas.
So
Appreciate
much.
your time too.
Appreciate it.
Cheers.